There's a crisis unfolding across America that most people don't see, hidden in marinas and boat dealerships, buried in financial statements that lenders don't want to discuss publicly. Boat loans are failing at rates not seen since the 2008 financial crisis. Defaults are climbing. Repossessions are surging. Lenders are writing off millions in losses, as boats they financed during the pandemic boom come back worth far less than outstanding loan balances. From January through April of 2025, only 64,883 new boats sold in the United States, down 9% from the same period in 2024, and the sales decline is accelerating. But the real crisis isn't just in new boat sales. It's in the loans financing those boats and the thousands of boats sold during the pandemic years. Buyers who stretched to purchase boats when money was cheap and optimism was high now face monthly payments they can't afford on assets worth far less than what they owe. Marine lenders report delinquency rates climbing steadily as borrowers fall behind on payments or simply stop paying altogether, choosing to let lenders repossess boats rather than continue throwing money into depreciating assets. Dealers financed inventory through floor plan loans now struggle to pay carrying costs on boats nobody wants, while manufacturers cut production by 13%, trying to stop the bleeding. This isn't a minor correction in a luxury market. This is a full-blown lending crisis that threatens the entire marine finance ecosystem, from the community banks that finance local boat buyers to the specialized marine lenders whose entire business models depend on healthy collateral values and reasonable default rates. Here's what most people missed. The warning signs were there years ago, but easy money and pandemic optimism obscured fundamental problems that are now destroying financial lives and threatening an industry. And that's where this story truly begins. To understand how boat loan financing reached this crisis point, you need to understand how marine lending works and how it evolved over decades to support an industry built on middle-class dreams. Boats have always been financed differently than cars or homes. Unlike cars, which serve essential transportation needs and hold value reasonably well in the first few years, boats are pure discretionary purchases that depreciate rapidly from the moment of purchase. Unlike homes, which typically appreciate and can be foreclosed through established legal processes, boats can be hidden, moved across state lines, or deliberately damaged before repossession. These characteristics make boat loans inherently riskier than auto loans or mortgages, and lenders traditionally compensated for that risk through higher interest rates, larger down payments, and more conservative loan-to-value ratios. In earlier decades, boat buyers typically put down 20 to 30% and financed the remainder over 7 to 10 years at rates that reflected the risk. Lenders underwrote loans carefully, verifying income and assets, checking credit thoroughly, and ensuring buyers understood the total cost of boat ownership, including insurance, slip fees, maintenance, and fuel. The defaults that occurred tended to be manageable because loan-to-value ratios meant repossessed boats could be sold to recover most or all of the outstanding balance. This system worked adequately through various economic cycles, including the devastating 2008 recession that saw boat sales crater and many marine lenders fail or exit the business entirely. The marine lending landscape that emerged after 2008 was more conservative and consolidated than before. Community banks that had financed local boat buyers pulled back from marine lending after suffering losses during the recession. Specialized marine lenders like Trident Funding and Essex Credit emerged to fill the gap, developing expertise in marine finance and establishing relationships with dealers nationwide. These lenders understood boat values, knew which models held value better than others, and maintained networks of marine surveyors and appraisers who could assess collateral accurately. The manufacturer's captive finance arms, Brunswick Financial Services for Sea Ray and Boston Whaler, Yamaha Financial for Yamaha boats, offered competitive financing as a way to support boat sales and capture additional profit on the finance side. Credit unions, particularly those serving military communities and coastal populations, maintained marine lending programs as member services. This ecosystem functioned reasonably well through the 2010s, financing boat purchases for qualified buyers while managing risk through prudent underwriting and realistic collateral valuations. The interest rates charged, typically 3 to 6% depending on credit quality and loan term, reflected the risk while remaining low enough that monthly payments were manageable for middle-class buyers financing boats in the $20,000 to $70,000 range that dominated sales volume. A buyer financing a $40,000 boat with $10,000 down at 5% over 10 years paid roughly $318 monthly, affordable for a household earning $60,000 to $80,000 annually. The system had achieved equilibrium between lender risk, buyer affordability, and dealer profitability. Then came 2020, and the pandemic shattered that equilibrium in ways that would eventually create the current crisis. As COVID-19 shut down normal life, and Americans sought outdoor recreation that didn't involve crowds or enclosed spaces, boat sales exploded. Dealers reported phenomena they'd never experienced: customers lining up to buy boats, bidding wars over available inventory, deposits placed on boats that wouldn't arrive for months. First-time buyers who'd never seriously considered boat ownership suddenly wanted in, convinced by social media posts showing friends enjoying boats while everything else was closed. The urgency was palpable and unprecedented. Buyers feared missing out on the pandemic escape that boats represented, feared that inventory would disappear completely, feared that prices would climb beyond reach if they hesitated. The lending environment supported this surge in ways that seem reckless in hindsight, but felt reasonable at the time. Interest rates dropped to historic lows as the Federal Reserve cut rates to near zero, trying to support the economy through pandemic lockdowns. Boat buyers could finance purchases at 2 to 3%, rates so low that monthly payments seemed almost trivial. A $40,000 boat, financed with $10,000 down at 2.5% over 10 years, required only $283 monthly. The comparison to what boat ownership had cost just a few years earlier made the financing seem like an incredible opportunity that might never repeat. Lenders, flush with deposits from pandemic stimulus payments and looking for yield in a low-rate environment, loosened underwriting standards. Down payment requirements fell. Buyers could finance 80 or even 90% of purchase prices. Loan terms extended to 12, 15, even 20 years, spreading payments over longer periods to make monthly costs manageable. The 20-year boat loans seemed absurd by traditional standards, but they made monthly payments low enough that buyers who couldn't afford 10-year terms could qualify. Income verification became less rigorous, as lenders assumed that employed buyers would remain employed and that boat values would hold or appreciate as they had during the pandemic boom, when used boats were selling for more than new boats had cost. Some lenders accepted bank statements showing deposits rather than requiring pay stubs or tax returns, making it easier for self-employed buyers or those with irregular income to qualify. The credit score requirements dropped as lenders competed for business. Buyers with scores in the mid-600s who would have been declined in earlier years found themselves approved, sometimes at higher rates, but approved nonetheless. The debt-to-income ratios that lenders would accept expanded beyond traditional limits, with some approvals going through for buyers whose total debt payments consumed 50% or more of documented gross income. The assumption was that the documented income didn't capture the full financial picture, that buyers had other resources or income streams not fully reflected in formal documentation. The competitive pressure among lenders drove the loosening standards. If one lender declined a buyer, 3 others would approve. So maintaining strict standards meant losing business to competitors who were willing to take risks that didn't seem unreasonable, given strong collateral values and low default rates. The approval rates climbed as lenders competed for business in a hot market. Buyers with marginal credit who would have been declined in earlier years found themselves approved, sometimes with higher rates, but approved nonetheless. Debt-to-income ratios that should have triggered declines were overlooked or rationalized. Yes, this buyer's total debt payments consumed 50% of gross income, but surely they had other income sources not fully documented. And besides, boat values were strong, so the collateral was solid. The manufacturer's captive finance companies offered promotional rates, 0% for qualified buyers, 1.99% for everyone else, as a way to move inventory and support dealer sales. These promotional programs cost manufacturers money through interest rate buydowns, but the profits on boat sales seemed to justify the expense. Credit unions, seeing members flush with pandemic savings and stimulus money, approved boat loans as a way to deploy deposits earning nothing. The marine lending business boomed along with boat sales. Lenders originated billions in boat loans during 2020 and 21, loans that generated fee income immediately and promised years of interest revenue. The secondary market for marine loans expanded as well, with lenders packaging and selling loan portfolios to investors seeking yield, effectively transferring risk while generating capital for additional lending. Nobody wanted to hear warnings that pandemic buying represented artificial demand, that borrowers were stretching beyond their means. that boat values inflated by scarce inventory would eventually normalize. The few voices urging caution were dismissed as overly conservative pessimists who didn't understand that the boating market had fundamentally changed, that new demographics were entering boating permanently, that the lifestyle shift toward outdoor recreation was permanent rather than temporary. The momentum felt unstoppable, the growth appeared sustainable, and the risks seemed manageable because collateral values were strong and default rates remained low. But the loans originated during the pandemic boom contained time bombs that are exploding now in 2025. The buyers who financed boats at 90% loan to value during the peak have watched their equity evaporate as boat values crashed. A buyer who purchased a pontoon boat for $60,000 in 2021 with $6,000 down financed $54,000. If that boat is now worth $40,000, the buyer owes more than the boat is worth. They're underwater by $14,000 on the loan alone, not counting the $6,000 down payment they'll never recover. The monthly payment that seemed manageable at 2.5% becomes a burden when household budgets are squeezed by inflation. That $283 payment on the $40,000 example doesn't sound like much, but add slip fees of $250 to $400 monthly, insurance of $100 to $150 monthly, and the ongoing costs of fuel, maintenance, and winterization, and the total cost of boat ownership approaches $800 to $1,000 monthly. For buyers whose incomes haven't kept pace with inflation, whose other expenses have climbed dramatically, whose pandemic savings have depleted, that burden becomes unsustainable. The psychology of being underwater on a loan compounds the financial pressure. Buyers paying loans on boats worth far less than loan balances feel trapped and resentful. Every payment feels like throwing money away. The temptation to simply stop paying and let the lender repossess the boat grows stronger as the financial pressure increases, and the underwater amount makes selling impossible. Without writing checks for tens of thousands of dollars, most people don't have. The default rates started climbing in late 2023 and accelerated through 2024 into 2025. Marine lenders initially treated rising delinquencies as temporary issues that would resolve as borrowers caught up on payments. They worked with borrowers through payment deferrals and loan modifications, extending terms or temporarily reducing payments. But as delinquencies persisted and turned into defaults, lenders recognized they faced systemic problems rather than isolated cases. The borrowers weren't having temporary cash flow issues that would resolve. They were making permanent decisions that boat ownership no longer made financial sense, that continuing to pay loans on underwater assets was irrational when they could simply walk away and accept damaged credit as the price of escape. The repossessions began slowly, then surged as lenders exhausted forbearance options and borrowers stopped responding to collection calls. The process of repossessing boats involves complexities that don't exist with auto loans. Boats can be stored in private garages or on private property, where repo agents can't access them without trespassing. Boats can be moved to different states or hidden in remote marinas. Boats can be intentionally damaged, engines run without water, hulls damaged, interiors vandalized, leaving lenders with collateral worth far less than anticipated. The legal processes for repossession vary by state, with some requiring court orders and others allowing self-help repossession, similar to auto loans. Lenders who successfully repossess boats face the challenge of selling them to recover loan balances. The repossessed boats enter an already glutted market, where used boats sit unsold for months, and prices continue falling. The losses lenders are taking on repossessed boats are staggering and accelerating. A boat financed for $50,000 during the pandemic might come back with $40,000 outstanding on the loan after the borrower made payments for 2 or 3 years. But that boat now sells at auction for $25,000 or $30,000 if it sells at all, leaving the lender with a $10,000 to $15,000 loss on a single loan. Multiply that across hundreds or thousands of defaulted loans, and the losses reach into millions of dollars, even for mid-sized lenders. The accounting treatment of these losses hits lender balance sheets immediately, reducing capital and forcing difficult decisions about future lending. Some marine lenders have pulled back from the market entirely, declining new loan applications and telling dealers they're not accepting new business. Others have tightened underwriting standards dramatically, requiring 30 to 40% down payments, limiting loan terms to 7 or 8 years, demanding excellent credit scores, and verifying income rigorously. These tighter standards make sense from risk management perspectives, but they further depress boat sales by making financing inaccessible for buyers who could have qualified during the boom. The community banks and credit unions that increased marine lending during the pandemic are now reporting losses that affect their overall financial health and regulatory capital ratios. The dealers are suffering parallel pressure from floor plan financing stress that compounds the retail loan crisis. Floor plan loans are the credit lines dealers use to finance inventory. When a dealer orders a boat from a manufacturer, the dealer doesn't pay cash up front, but instead finances the boat through a floor plan lender, who pays the manufacturer and charges the dealer interest until the boat sells. Floor plan financing has always been central to the boat dealer business model because inventory is expensive and holding costs are significant. A dealer stocking 30 boats worth an average of $50,000 has $1.5 million in inventory financed through floor plan loans. During normal times when boats sold within 60 to 90 days, the floor plan interest was a manageable cost of doing business. But boats that sit unsold for 6 months or a year accumulate interest charges that consume dealer profits or create losses. A $50,000 boat sitting in inventory for 6 months at 6% annual interest accumulates $1,500 in floor plan charges. If the dealer eventually sells that boat for $45,000 after discounting to move aged inventory, the $1,500 in floor plan interest turns a small profit into a loss before considering dealer overhead and operating costs. The floor plan lenders, often the same institutions providing retail boat loans, are becoming increasingly aggressive about reducing dealer credit lines and demanding payment on aged inventory. Dealers receive curtailment notices requiring payment of principal on boats that have been in inventory beyond specified periods, typically 90 to 120 days. These curtailment demands force dealers to either pay down floor plan balances with cash they often don't have, or return boats to manufacturers who may or may not accept returns, or sell boats at whatever prices buyers will pay regardless of losses. The cascading effects are creating a crisis that feeds on itself in self-reinforcing cycles. Lenders tightening standards makes financing harder to obtain, which reduces boat sales, which creates more dealer inventory, which forces more discounting, which reduces boat values, which creates more underwater loans, which leads to more defaults, which increases lender losses, which causes more tightening of standards. Breaking these cycles requires either dramatic improvements in affordability or a complete capitulation in boat values that clears the market at prices buyers can accept. Neither seems imminent. Interest rates have stabilized at levels around 5 to 7% for boat loans, rates that aren't historically high, but are roughly double what pandemic buyers enjoyed. The Federal Reserve has indicated interest rates will stay elevated as long as inflation remains above target levels, meaning boat buyers shouldn't expect return to 2 or 3% financing anytime soon. The affordability calculation is brutal. Monthly payments at current rates are 30 to 40% higher than they were on equivalent loans during the pandemic. A $40,000 boat financed at 6.5% over 10 years requires monthly payments of roughly $455 compared to $283 at 2.5%. That $172 difference represents over $2,000 annually, enough to cover insurance and part of slip fees, but now consumed by higher interest costs. For buyers on budgets, the higher payments simply make boats unaffordable regardless of desire. The human cost of the boat loan crisis extends far beyond lender balance sheets and dealer finances. The borrowers in default face damaged credit that will affect their ability to obtain financing for homes, cars, or other needs for years. The stress of collection calls, repossession threats, and financial judgments takes psychological tolls that affect families and relationships. The borrowers who purchased boats as family recreation find those boats repossessed. The dreams of weekend getaways and fishing trips replaced by damaged credit and lingering debt if lenders pursue deficiency judgments for the difference between loan balances and repossession sale proceeds. Some borrowers face lawsuits seeking those deficiencies, judgments that can lead to wage garnishment or asset liens that persist for years. The dealers facing floor plan pressure lay off employees to reduce costs, eliminating sales positions and service technicians who've worked in marine industries for years or decades. The family-owned dealerships that survived the 2008 recession now face a second crisis, that many won't survive, forced to close and liquidate inventory at bankruptcy auction prices that destroy any remaining equity. The communities where these dealers operated lose businesses that were institutions, that sponsored youth sports teams, that supported local charities, that provided steady employment and tax revenue. The lenders suffering losses reduced their willingness to finance not just boats, but other consumer purchases, tightening credit availability across categories, and contributing to broader economic weakness. The regulatory scrutiny of marine lending practices is increasing as the crisis becomes too large to ignore. Banking regulators examining lender loan portfolios are questioning the underwriting standards that produced such high default rates and asking why lenders didn't foresee problems that now seem obvious. The examinations are resulting in enforcement actions requiring lenders to increase reserves against future losses, reserves that come from capital, and reduce lending capacity. Some lenders face restrictions on originating new marine loans until they demonstrate improved risk management and workout procedures for troubled loans. The consumer protection agencies are investigating whether lenders engaged in predatory lending by approving loans for borrowers who clearly couldn't afford the total costs of boat ownership, whether dealers made misleading representations about boat values and appreciation potential, whether the promotional 0% financing programs adequately disclose terms and conditions. The legal liability exposure is significant. If regulators or courts find that lenders or dealers engaged in unfair or deceptive practices, the damages and penalties could be substantial beyond the direct loan losses. The class action attorneys are circling, looking for theories to sue lenders and manufacturers on behalf of borrowers who claim they were misled about boat values, appreciation potential, or total ownership costs. While individual borrowers signed loan documents and purchase agreements that presumably disclosed terms, the arguments focus on whether the disclosures were adequate and whether representations made verbally contradicted written disclosures. The crisis raises broader questions about consumer credit, asset bubbles, and the responsibilities of lenders and borrowers in speculative markets. On one level, the boat loan crisis represents a failure of underwriting discipline. Lenders approved loans they shouldn't have, for borrowers who weren't qualified, on collateral whose values were inflated by artificial demand. The lenders should have known better, should have resisted competitive pressures to loosen standards, should have maintained conservative practices regardless of what competitors were doing. The regulatory framework for marine lending is less developed than for mortgages or auto loans, giving lenders more discretion and less oversight. That freedom allowed flexibility, but also enabled practices that proved disastrous when markets normalized. On another level, borrowers bear responsibility for decisions to finance purchases they couldn't afford, based on optimistic assumptions about their financial futures and boat value appreciation. Nobody forced buyers to take 90% financing on boats, to extend loans over 20 years, to purchase boats that stretched their budgets even at low interest rates. The borrowers made choices, signed contracts, and bear consequences of those choices, including damaged credit and potential deficiency judgments. The middle ground recognizes that both lenders and borrowers made mistakes encouraged by a unique moment when pandemic disruption, government stimulus, zero interest rates, and social media created conditions unlike anything experienced before. The lessons, if anyone learns them, involve recognizing that easy credit enables poor decisions, that asset values inflated by artificial demand eventually revert to sustainable levels, that financing rapidly depreciating assets requires conservative loan terms and substantial equity cushions, and that boom times don't last forever, regardless of how permanent they seem. The path forward for the marine lending industry involves painful adjustments that will reshape how boats are financed and who can obtain financing. The lenders who remain in the market are implementing underwriting standards that would have prevented the current crisis. Down payments of 30% or more, loan terms limited to 10 years maximum, debt-to-income ratios capped at conservative levels, full income verification including tax returns and pay stubs, credit scores in the excellent range. These standards price many potential buyers out of the market entirely, particularly younger buyers and middle-class families who represented core boat-buying demographics. The market that emerges will likely be smaller, concentrated among wealthier buyers who can afford large down payments and higher monthly payments, supplemented by a robust used boat market where buyers pay cash or finance through personal loans or home equity lines. The specialized marine lenders who built businesses on boat loan volume face existential questions. If the market shrinks by 30 or 40% from pandemic peaks and stays there, can they sustain operations? Or do they need to diversify into other lending categories or exit the business entirely? The manufacturer's captive finance arms face similar questions about whether subsidized promotional financing makes sense in a market where collateral values are falling and default rates are elevated. The credit unions and community banks that expanded marine lending during the boom are pulling back, redirecting lending capacity toward less risky categories like mortgages and auto loans. The technology and business models emerging from the crisis may change marine lending fundamentally. Some lenders are implementing more sophisticated collateral tracking using GPS and telematic systems that monitor boat locations and usage, making it harder for borrowers to hide boats or move them without lender knowledge. The technology exists to remotely disable boats, shutting down engines or electrical systems, though the legal and practical implications are complex and ethically questionable. The marine surveys and appraisals that were often cursory during the boom are being taken more seriously, with lenders requiring detailed inspections before approving loans to ensure collateral values support loan amounts. The standardization of marine lending through automated underwriting systems similar to those used in mortgage and auto lending could improve consistency and reduce human judgment errors that contributed to the crisis. Though boat lending's inherent variability and smaller market size may limit automation potential, the growth of peer-to-peer lending platforms where individuals lend to borrowers directly, bypassing traditional financial institutions, may extend to marine lending, though the complexity and risk would likely limit participation to sophisticated investors. The marine lending landscape that emerges will be more conservative, more technology-enabled, more focused on borrower ability to repay rather than collateral values, and more realistic about the risks inherent in financing rapidly depreciating discretionary purchases. The boat manufacturers and dealers must adapt to a financing environment that will constrain sales for years, regardless of product quality or dealer service. The assumption that buyers can finance 80 or 90% of purchase prices no longer holds. 30% down payments mean buyers need $15,000 to $25,000 cash to purchase $50,000 to $75,000 boats, cash that many middle-class families don't have and can't accumulate quickly. The manufacturers are responding by developing more affordable models priced below $40,000, where 30% down payments become more achievable. The emphasis is shifting toward smaller boats, simpler layouts, fewer features and options that added cost without adding proportional value. The strategy recognizes that the mega boats and feature-loaded models that drove revenue during the boom have priced themselves out of markets where financing is constrained and buyers are cautious. The dealers are adapting by expanding used boat sales and brokerage services, recognizing that the used market will dominate for years as inventory works through the system and buyers opt for value over new boat features. The service departments are becoming more important to dealer profitability as new boat sales decline. The maintenance, repair, winterization, and storage services generate steady revenue that can sustain dealerships through sales downturns. The creative financing solutions dealers offer, lease programs, fractional ownership, boat clubs where members share access to fleets, may expand as alternatives to traditional ownership and financing. The question facing the industry and the consumers it serves is whether boat ownership will remain accessible to middle-class American families or become predominantly a wealthy person's recreation. The trajectory suggests troubling answers. If financing requires 30% down and supports only 10-year terms at 6 to 7% interest, the monthly payment on a $50,000 boat with $15,000 down becomes roughly $412, manageable but at the high end of what middle-class families can afford when adding ownership costs. The total monthly cost approaches $700 to $900 when including slip fees, insurance, and operational reserves. For a family earning $70,000 annually, that represents 15 to 18% of gross income devoted to boat ownership, a percentage that's difficult to sustain long-term given housing costs, transportation expenses, and other obligations. The reality is that boat ownership is becoming concentrated among higher-income households who can afford the cash outlays and ongoing costs without financial stress. The middle-class families who bought boats during the pandemic boom are exiting boat ownership, sometimes voluntarily through sales and sometimes involuntarily through repossession, and they're not being replaced by equivalent numbers of new buyers. The demographic shift has implications beyond industry economics. If boating becomes predominantly a wealthy recreation, the political support for public boat ramps, marina subsidies, and access to public waters may erode as fewer voters have direct stakes in boating infrastructure and policy. The crisis in boat loan financing is ultimately a story about American optimism, meeting economic reality, about dreams encouraged by easy credit colliding with financial discipline. The buyers who financed boats during the pandemic wanted to believe the good times would last, that their jobs were secure, that boats would hold value, that the lifestyle would justify the expense. The lenders who approved those loans wanted to believe their underwriting was sound, their collateral was solid, their risk management was adequate. The dealers who sold the boats wanted to believe the market had fundamentally shifted to a new higher level of demand. Everyone involved had incentives to believe optimistic narratives and ignore warning signs. The crisis destroys those beliefs and replaces them with hard truths. Most boats are terrible financial investments. Financing depreciating assets requires discipline and equity cushions, and boom times driven by artificial circumstances don't represent sustainable new normals. The industry that emerges from this crisis will be smaller, more conservative, more realistic about what it can promise and who it can serve. The dream of boat ownership will survive because the appeal of being on water is real and powerful. But the path to achieving that dream will be harder, requiring more patience, more savings, more realistic assessments of affordability and value. The crisis no one is talking about is destroying financial lives and reshaping an industry, and the consequences will echo for years in damaged credit reports, closed dealerships, and dreams deferred or abandoned. Do you have a boat loan? Are you struggling with payments, watching values fall below what you owe, wondering if you should keep paying or let the lender repossess? Are you a dealer facing floor plan pressure, trying to survive in a market where financing is tight and buyers are scarce? Have you worked in marine lending and watched your portfolio deteriorate, seen default rates climb, faced pressure to tighten standards, or exit the business? The boat loan crisis affects hundreds of thousands of people across America: borrowers, dealers, lenders, manufacturers, marina operators, and the communities that depend on healthy marine industries. Understanding how we reach this point helps us recognize the warning signs in other markets and other lending categories, helps us make better decisions about credit and purchases, helps us demand better from lenders and dealers who profit when times are good, but leave consumers and communities to absorb losses when bubbles burst. If you value in-depth, honest reporting about America's maritime industries and the economic forces shaping boat ownership and finance, subscribe for more boat industry documentaries and breaking marine news that goes beneath the surface of press releases and industry cheerleading to examine the realities facing the people who build, sell, finance, and own boats in a rapidly changing market.